Hello and welcome to the Harwood Report for August 6, 2018. I'm Keith Harwood, the founder of Trade Academy. Standard legal stuff, always got to put it up here because my lawyer said to. So it's all services and content are provided for educational and information purposes only and are not intended as legal or financial advice. Please take a moment to glance through the rest of this and make sure you understand the disclosures. All right. Normal highlights. Talk about macro indices, talk about bonds, talk about gold, talk about oil. Everything's moving a little bit today. So what does it all mean? Well, first off, let's go to fear and greed. 73. I think that's misstated. So people that look at this, they are, I think, going to think that the market is acting more greedy than it is. And the reason I say that is when you look at the things that are extreme greed, you look at the 6-month period, yeah, they look greedy. On the 1-year period, they don't. Same here. Extreme greed, I don't buy it. That's not even greedy, extreme greed on a 6-month period, I mean, even a 3-month period. This is finally starting to get to show some extreme greed. Maybe we're getting close there, but it's not nearly as extreme as we've seen in the past. So a lot of the stuff that's showing extreme greed doesn't necessarily illustrate real extreme greed to me. So what do we have going on here? S&Ps are above that end of July high, the July 25th high. Looking like they're ready to ramp higher. So when we've had these rotations at the end of the month, they've generally helped pull us back a little bit more aggressively. So this was the end of May, end of June. Look at end of July. It was only about 3 or 4 days of pullback before the next go. Maybe it sets up a little more like this kind of move where it wasn't even that big of a pull back, but that set us up for about 6 more points really quickly here at the beginning of June. 6 more points would put us well above the January all-time high. Volatility in the landscape here is very, very cheap relative to what we've seen over the last 3 to 6 months. But generally, if we go back to December, we've got more room to fall. So if people are going to start forgetting about the VIX, forgetting about February, this becomes a bit more of an explosive potential. And I want to show you guys this because I was talking about it a little bit last week. There's 3 more days until this just falls off my chart if I'm looking at a 6-month chart. So people that are looking at 3-month charts see a tight range in the VIX of 11 to 18 basically. People that look at a 6-month chart say, gosh, 11's really cheap because we've been as high as 42. Well, guess what? When these 3 fall off, now the highs are around here in the high 20s. That changes people's mentalities. The reason I talk about this 1 to 6-month thing is that some people use rolling time frames to calculate their risk measures and everything else. So if a computer VAR system, value at risk metric from a fund, is based upon 6 months of data, well, guess what? If these 3 days, really these 5 days fall off, the 6 months of data really allows them to potentially take different risks than they could when these are being factored into their models. I think that's helping create a tailwind for the market. In addition to the normal start of month money flow. Tech is testing highs, but SMH has been lagging. So if SMH can get some fall through here, the semiconductor index, then that could actually really help tech go even further. Tech's being driven up by the new big 4, Apple, Microsoft, Alphabet, and Amazon. So those 4 seem to really be driving it, but those 4 make up more than 40% of the QQQ index, so it makes sense that those 4 would drive it. And finally, IWM small caps have really been trading this tight coil. It looked last week like it wanted to try for a breakout and then got or last weekend or two, it wanted to make for this breakout, make a new high here above 170, pulled back, and now it's been drifting higher. And it looks to me like this liquidation that started on July 27th is getting eaten up right now. If it can get above 170, that can make small caps explosive and really put a lot of positive money flow into the markets because I think we're dealing at that point with a very bullish sentiment. That may be what helps create a top in the market. We'll see how it goes. Short-term top, not a long-term top, because earnings were generally good. We know that trade rhetoric right now has been a negative on the market, and yet it's not causing any real pullback anymore, as I think that people are starting to recognize that it's not adversely affecting the United States thus far. We'll see. In terms of the stock market, there may be individual sectors that get hurt, but overall, the market is getting rebalanced where some things are getting a benefit and others are getting a negative. When I go over here to TLT, it's an unclear chart to me. The thing that I can really say about TLT that's interesting is not in the that landscape. It's in the volatility landscape. So much like the VIX is cheap here, if I look at the vol on bonds, it is about as low as it gets. 8.5 is pretty darn cheap here, and we're playing around with those levels. If I even go back the last year, so I go into include December, that really this is as low as it got last year in the lowest volatility environment. So if bond vol is this low, maybe the best play is something in the volatility scape here. I'll talk about that, or I did talk about that in the premium newsletter that I posted earlier, and how I like to play that given what's going on in the world. If you want the premium newsletter, check the link at the end of this video. Continuing on here, after TLT, I go to the gold situation. And I'll tell you right now, the biggest issue for me in gold is that, this gold looks like it could fall off here, but it could also ramp higher from here. I'm not sure which way it goes, other than knowing that the dollar relative to the yen here is in chopping land. So if dollar yen gets weak, I think that could create an actual short squeeze in gold because this positioning is so small. If dollar yen starts to firm more, GDXJ actually seems to me like it has a better R&R to the short side, because these miners should start to get hit pretty hard if gold's going to get cheaper. And they're not trading in those recent lows where gold would be trading. So, if it was trading where it was last time gold was down here, we'd be talking about $1.50 lower. That's 5% lower. So there's already 5% that's not being priced in, partially because, equities on the whole have been firm. So people are, I think, still allocating money to equities, and that just includes this when it's part of the basket. So that's part of what might be holding it up. SLV is very similar to gold. In terms of volatility, all of these are generally on the low side, and I can talk about that more in the newsletter, as I mentioned. But I want to get over to oil. So there's been some changes with Iran, and that's causing a bit of a bid back to oil. And now that's starting to fade a little bit here into near the close, but you can see that we're kind of trading in this chop area. But if we close up here, we're above the recent moving averages. So we're above the 10-day, we're above the 20-day, we're above the 50, 100, and 200 that we haven't been able to breach. And I think it might start giving some people confidence that this chop down is going to resolve to the upside. And if it does, XLE can resolve to the upside as it tests this long, kind of coiling situation here between about 74 and 78. A push through 79 gets that even more explosive. OIH, I think, has more explosive potential only because the pullback's been greater. So you can just see how OIH could really get moving here above 29. And that's a long ways away with options as cheap as they are in OIH. OIH vol, I'll show you guys here on the chart. It's dirt cheap here at 23% relative to history. If I go back a year, it got down to 21%, 22% of the lows last year when the VIX was single digits. So we've really taken a lot of volatility out of energy names. So there's a lot of, I think, money to be made if those squeezes start to happen. And one other one I just want to point out is XOP, because it's the best performer today in the oil landscape. It's been much more correlated to oil, so if oil does continue to firm, I wouldn't be surprised to see this press to 45 before maybe even the OIH or XLE breakouts really happen. So that's something just to watch. That's kind of where we're at for this week. I think it's I think a bullish week because of the money flow on the whole, barring something just going crazy wrong with Chinese tariffs. But how can anything really go crazy wrong when it's already seemingly at its worst point? We're not having conversations with them. So what would cause us to think that there's something even worse than just not even talking to them about how to make it better? I'm not sure. The market has surprised me before. That's why I like using options for defined risk and leverage, and that's what I talk about more in the Harwood Report newsletter. And you get 2 weeks for free if you sign up now. I made a mistake here. I left this at $49 a month on the thing. So I'll tell you what. I'll leave it at $49 for 2 days. I'll put it at $49 again for 2 days. After that, it's going to go to $97. I forgot to change it on the slide, and I'm going to honor it because that's just how it's going to work. So if you sign up in the next 2 days before Wednesday, before, say, 3 o'clock on Wednesday, so you get the midweek update on Wednesday during market hours, you can get it for $49 going forward if you keep the subscription. If you don't sign up by Wednesday, after that, you can still get a 2-week trial for free, but then it's going to be $97. So those of you that sign up before Wednesday get it for $49 as long as you keep your subscription. Those of you that don't get to pay $97. So would you rather pay $49 or $97? Seems to me like it's worthwhile to sign up for that trial today. So you have the option for it, knowing that you can cancel before your free trial's up and not pay a dime. Go to tradeacademy.co/Harwood Report to sign up. And I hope to see you all clicking on the newsletter that's already been posted and talking about some more specific trade ideas for these ETFs. You can always email me, Keith@tradeacademy.co, or call me 312-600-8004. Have a great afternoon, everybody.